Alright, hello trade pros. This is lesson number 3 of our free day trading course. If you guys have enjoyed what you've seen so far, drop a comment, drop a like, and tell me what else you want to see. Also, don't be shy and pop in some comments. Let me just open up a other tab here and let me see some of these comments if they do pour in. But in today's lesson, we're going to be talking about market structure, and I'm going to show you some quick techniques of just using market structure alone to actually trade and day trade the futures market. And all you need is market structure, as I will explain it throughout this video. But if you guys don't want to miss any more of these live presentations, there's a link down in the description. Please click that and sign up, as at the end of this course, we will be offering a one-time limited offer. So join us. And if you guys want to check out more order flow stuff, as we will be going into later on in this course, lesson number 4, we're going to be diving deep into order flow and how you can use that to your advantage in the futures market. There's another link in the description. Pop on over and check out our free order flow trading course. Now, let's go ahead and get this going. So in today's class, what we're going to be talking about is market structure. We're going to continue market structure as we gave you a little glimpse of the actual definition and everything last lesson. We're going to be going into a deep dive, and we are going to also be looking at the important aspects. So I'm going to explain what impulses are very important in market structure that a lot of people don't really know and aren't really aware of. But we're also going to jump into how to read any market based on just pure market structure. So that's going to be a very interesting aspect for a lot of people. So you don't only have to use this for day trading and trading futures, but you can use it in any other market condition. And then we're going to be talking about Candlesticks 101, and this is going to be a short lesson, as in the futures market, especially if you're using range bars to day trade, there's not really going to be too many different candlestick patterns, but they are really important still, and we're going to talk about how you use them in other market situations as well. If you're looking at stocks or even swing trading, investing, whatever it is, all aspects of technical analysis can be seen. Now, we're going to talk about which ones are important, some candlestick patterns, and then combining the two to actually day trade futures. So all you need in this lesson we're going to show you is just market structure to actually start day trading futures without all the other fancy stuff. Now, in terms of market structure, let's review the macro structure versus the micro structure. So the macro structure of a market, especially when you're day trading futures, we like to look at a larger time view. And by a larger time view, that may be a little surprising to many people, but it could be as much as just 5 days of price action. So what I have in front of me is a 10-tick range chart where we can see the past about 8 days or so. So not that much movement. It's not that expanded, but you can see a large view of what's going on in the market right here. It does tell the story of an upside trend, as you guys can see, higher highs, higher lows, pretty evident. And within each of these little impulse moves, little continuations, you can find a lot of opportunity. For example, from the bottom of this move, we start at 32.30 about all the way to 3300. So that's about 70 points of movement, and remember, 1 point of movement is worth $50 on an S&P 500 contract, which is the chart that we're looking at. So the macro structure, in our essence, we'll be talking about a 10-tick range, 15-tick range, 20-tick range, something larger to actually see the overall view over the past few days only. And then we jump into the microstructure of the move. In front of me is just a 4-tick chart with just 2 days of price action, or about 2 sessions of price action, the overnight and the day, the US session day. So that's really intricate here, and the purpose of the microstructure or the 4-tick or the 1 point range is that you see the very intricate movements and the rotations of the current day session, the current session that you're actually trading, which is really important to see those levels a lot more clearly. You can see where price starts to move higher. You can see impulses holding resistance as new support after breaking it, and a lot of these blue lines that identify those market structure points, where we're going to talk about just in a few moments here. Now, why is market structure king? A lot of people kind of miss this in the basics of their learning and understanding of day trading, and especially day trading futures. We have to start with market structure before we can add any other tools. Even if you guys like indicators that we don't really advocate, but also order flow tools, whatever it may be, you have to start at market structure. Why is that? Because it shows you the actual price movement and the general direction of the trend, and it holds true until the trend breaks. Now, using these tools can help you guys identify the potential of a next move and increase the probability of understanding where the market will go based on where previous peaks of support and resistance are and how to identify that actual market structure and its continued moves. So again, market structure identifies a general support resistance areas, and the key is understanding how to read it so that you know when the market will continue and when it will break in the opposite direction of the trend. Now in front of me here we have a 5-point range. So this is a 20 tick candle chart on the S&P, and you can see this is a macro view of what we perceive as a macro view in the futures market. You can see how many days from December 22nd all the way to January 17th, almost a month's worth of price action right here. And you can see this overall macro trend. Anything above a 4 tick, I would say, is more of a macro view of what's going on in the market. You can see a lot of price action here, and you can see resistance areas very clearly. 1, 2, 3 peaks. These are strong resistance in this area right here. And as we break above that, we expect it to hold as support, as it does right here at 32.50. So that's a continued move of the market structure right here. You could also say 1, 2, 3, these peaks lower right here at these 32.10s or 12s. This is really strong support in this channel right here. And if we break through that, you hold it as resistance for the continued move lower. And what happens when you stop printing lower lows, lower highs? If we first initially break this right here, you can see this was a lower high, lower low compared to this lower low. What happens? We don't print a lower low, but we print a lower high. So that could be the first identification of the market structure shift, maybe to the more neutral or upside, and then officially switches to the upside above this resistance point. Now, impulse moves and continuations. We really love impulse moves because they identify last chance levels for the continued move in that direction of the trend and also where the trend starts. So the impulse move is the starting point of a market movement that either prints a higher high or a new high or a lower low, a new low, depending on the direction of the trend. So right now, if we use these points as resistance here, where is the impulse move to generate the new high past these resistance points, these little triple tops here? It starts somewhere in this area at the support structure at these 32.80s, 32.78s or so. So that 2-point range is where the impulse actually starts to create this new high right here, right? So that means on the reversal or on the pullback, markets can theoretically, once printing a new high, once punching a new high, turn down back into this level to hold that structure as support, as the last chance level for the bulls to continue this trend. Now, what happens here is we break these previous peaks, and you could say maybe the impulse for this move might be somewhere here off this peak break, or maybe down here. But again, this is a 5-tick chart, a 1.25 point chart, and the fact that we break this area as resistance right here, this structure means that it turns support, and we expect those lines to hold as support on the retrace. So when we're talking about market structure, we have two identifiable levels for the continued move. If this is a bull trend and we're continuing to the bull side, we've got a move above these resistance points right here and a rotation back down into that resistance structure for the continued move to the upside, or we have the pullback into the impulse at which the new high started or the new high broke. Again, if we use this example right here, you have a triple top and you break this area, you pull back down into these little areas right here, 32.90, and it comes back into the previous resistance or the previous peak higher as we're expecting it to hold as support structure. Now what happens here, this move at these 32.90s or so creates a new high into 32.98, and this now becomes the impulse for a new high. So that means we have two potential trade opportunities here, and that is one, the break of the previous high, rotation back into it to hold as support structure and continue higher, or the rotation back to the impulse at which it started, which is what happens right here as price moves down to the impulse structure and continues up to the upside, barely printing a new high. When we see higher highs and higher lows printed in the upward structure, we want to see clear breaks of the previous peaks. So 32.97 was its previous peak. We break it by about 2 points, which is not significant. We want to see a significant break of about 4 to 5 points and then rotate back down into that structure to hold it as support. What happens is a 2-point break, and then we rotate back actually to where the impulse started for that new high, and that holds a support structure. Incremental new high prints, comes back down to the impulse, and this time no new high prints, which means that you could start forming the idea that maybe this structure might break down slightly to the downside through these support structures. structures through the support level. So what we want to see is significant higher highs, higher lows print, or the impulse hold as support, but we need to see a significant break to the upside. Once we start seeing these incremental breaks of peaks higher, then we can start shifting the idea. Maybe this might be a failure at that level and a slight switch in upside structure, which happens right here when we fail to print a higher high, which can be translated easily to the bear market once you flip all of this to the downside and the downside market structure. So if we break these lows right here, we want to see a significant break, rotation back down to either where the impulse of the break started or the broken level that has now turned resistance. Now, changes in market structure, like we just talked about, macro versus micro, what do you trade? So when it comes to what we actually trade, where we trade on, we'll look at the microstructure for that day session because that is what day trading is all about. We're trading the current session, so watching the microstructure form out is where we actually place trades and identify trade levels. The macro structure is where we identify the key levels of support resistance for the continued moves on a larger scale. Now, when it comes from shifting from bears to bulls or bulls to bears, again, the last chance level is going to be the impulse move that brought you a new high or a new low. If you break that impulse movement, then we start shifting the market structure to a different tone. So right here, in terms of an example, this is a larger time frame chart, or not time frame, sorry, larger range chart. So you can see a lot more structure here, and these are the previous peak higher, right? So one, two, three, about 3 to 4 peak higher, and what we're expecting is a break for that level, break above that level for the bulls to take control, or you've got a triple bottom right here, break through that level at this triple bottom for the bears to take control. So the bears managed to break it through this bottom initially, and where does the impulse for the break actually start? What we're watching for is, in terms of the impulse move, consistent bear candles to start it. So you could either say the impulse move started at 32.40, or you could say it started at 32.30 down here, where you can see this is where the black candles, the bear candles, actually just continued for the break below that support structure. You got the slight pullback into support and continuation, slight pullback into the broken, now resistance, continuation. And what we want to see is now this is the impulse that started a new low right here, down here, 32, where is that? About 3,200 or so. So this impulse becomes the last chance for the sellers to continue the move lower, and we pull back into the previous broken low for the first level of resistance. Doesn't hold, impulse doesn't hold. We start shifting the market structure to the upside when we eventually actually break this triple top, quadruple top, and pull back into it for the continued move higher. Now, if we drop down to a 10 tick, so 2.5 points of a range, you could see structure a little more clearly, a little more intricately, and the more you drop down, you can see it clearer and clearer. Now, again, same thing here. If we take any of these points and we look at where the impulse started, where the continued moves are, you can just identify any of these levels just knowing what the impulse is and what the trend continuation break is. So right here, we start a shift to the upside. You can see the peak higher past this broken area right here started from this impulse down here, and now we could either pull back into two areas to continue this move, somewhere between these peaks that were broken, or a pullback down into the structure support where this impulse is. These peaks hold out as support and we continue the upside move. Now the same thing, where did the impulse for the new high start? Right here. Where was the previous resistance broken? Right here. So we can either pull back into this high, or we can pull back into the impulse for the continued move. Now, pulling back into those areas is the first step. The next step is to see if market actually prints new highs off those pullbacks. What happens here, you get some of that support structure and holds out for the bull side, but at some point, you actually break the impulse that starts some of these moves, but you can identify that before the impulse even breaks because you're starting to print lower highs. You stop printing higher highs here, which starts turning the sentiment and could give you the idea that the market structure is actually starting to shift slightly. Now, you can apply these principles to any market, just understanding where the impulses are and the trend breaks and how to actually read that. Now, you can do it on a time frame chart, you can do it on a Renko, whatever it is. And I'm going to show you guys a trading view example here. If I pull this screen over, we'll take any stock, let's say Apple. I was on VNQ, but we can do this on any stock right now, right? So if we just drop down into a 1 hour, you can see the impulse moves and all the peak higher that break. So right here, if we take this for example, the current price action, we have a double top around this area. Now, what does that mean? From this double top, you can identify two potential next best trade is to continue to the upside. First things first, you can identify that the trend is to the upside. There's no doubt about that. Now, that means that you're looking for longs. The first level would be a break above these previous highs right here. And we could see a movement like this. Once we break that high convincingly, we'd want to see a pullback back into that previous high that breaks, and then a continued move higher. Now, if this structure starts from here and breaks a new high, that means that the impulse move is actually down here, right where the structure actually started to break and the continued move started. So if the impulse starts from here, that means the last chance for the bulls would be at this area. However, it could be possible that in the next few days we see a pullback maybe into these areas, right where some of this impulse started from a new high, and hold that structure support down into these areas. Now, if the impulse starts from here, let's say, to continue a new high, the last chance for the longs now becomes down into this area. So you could grab any different stock, any time frame, any asset, and apply these same principles to it. It's pretty simple once you understand the market structure. Now, moving on here, you could actually only trade with market structure. That could be the only tool you ever use day trading futures. And if you understand all the intricacies and all the impulse moves and breaks higher and the continuation of moves and the reversal of moves, then you could only trade on market structure. When it comes down to futures, we use the 10 tick for a more macro view, quote unquote, and then a 4 tick for a more intricate view. We actually have a few traders in the group that just trade purely on market structure, David being one of them, one of the TradePro coaches, and all he uses is market structure to identify his moves and play off the actual price action, support, resistance, and continued moves. Now, if I show you guys an example of that, this is a 4 tick. Now, the 10 tick was used to draw these blue lines that identify support resistance structure, but this is a day session right here, right where this blue volume profile starts. Now, if we make a move to the upside, you can see previous areas of resistance are right here, labeled by this blue line around 32.88. And the idea is we break above this structure support resistance area and turn into support. Now, we get a significant break and we're looking for pullbacks into that broken support structure. We get a few incrementally and then we create a new high. Right, we pass that new high. So the impulse starts from somewhere in this area, these 88s, 89s for that new high. Or you can break this previous resistance band, which was identified from levels before at these 91s, pulling back into it, holding its support. Now, this is the support structure that holds for the continued move where you could be looking for longs, and it also begets the impulse move for the new high that prints here. So that means if we're not breaking this previous peak higher significantly to pull back into it, that means the pullback is back into these impulse moves, which holds out really well. Again, same thing, incremental shift higher, whereas the pullback to hold support, these impulse moves. So it's pretty simple if you understand how the market structure actually works. Now moving on to candlesticks here quickly. In terms of day trading futures in the range bars, we think that there's about 3 candlesticks that are worth knowing. The doji, the hammer or pin bar, the two of them do the pretty similar things in terms of identifying what they how they continue moves or how they may stall moves, but they're pretty interchangeable when it comes to range bars and the long body. Now the doji is a very simple candle which has pretty much no body and it has an extended wick. We use this candle as a fight area, an area of support resistance in terms of coming into a support structure line to hold out a fight between buyers and sellers, which means a reversal candle if it's coming into a pullback area. So if price is pulling back from a high coming down into a support structure, you want to see a couple of dojis print, meaning that maybe more buyers are coming and stalling out the sellers. The hammer or pin bar does a pretty similar move depending on where it is. So at the bottom of structure, if you're getting more extended bull pin bars or hammers, you're looking for a more continuation or reversal to the upside, and the same thing for these bear candles. Now, if you see these guys at tops of moves, you could maybe identify that this might be the end of the top move, looking for the pullback into one of these areas so that maybe more dojis or more extended pin bar or hammer candles of the bull variety come in to hold that support structure. When it comes to long bodies, these are really good for identifying the continued move of the trend. You want to see these guys stack up one after another, meaning that the trend will continue in strength. So if you get a bunch of white ones or bull ones continue one after another, that means the upside trend is pretty strong. And the same thing to the downside with these extended black or bear candles. Now, some of the chart patterns to day trade futures in terms of candle pattern sticks, sideways long bars, dojis, and hammer candles, and you'll have to use these in conjunction with market structure. So what these mean, let me just go back to one of these charts and we can identify some of those sideways patterns that I was talking about. So the sideways patterns and some of the hammer and dojis are really important. So the sideways patterns on long extended long body candles are really important because that means that that's a fight at a support resistance area. And this is what we call rotations. So down here, the area that I'm circling with my mouse between 32.77 and 80 or so, you can see these long extended candles with a mix of dojis or hammer candles right here. These rotations right here identify extremely strong support levels, which you could play off for longs in the continued move to the upside. Once you see rotations like these, mainly if they're sideways, the sideways pattern, chart pattern, candlestick pattern, quote unquote, that I like to call it, or rotation pattern with these long bodies, this identifies a very, very strong rotationary support structure. Likewise here, long bodies rotating is resistance. Again, right here, long bodies rotating at a resistance point means that there's more selling coming in. Long bodies, again, support structure. Depending on where you are in terms of market structure, you could use these very, very simple candlestick patterns. So when it comes to candlestick patterns, you really have to use them in conjunction with the market structure. Otherwise, they're kind of rendered useless because they could be anywhere in terms of the market structure, and you could identify potential trade areas or trade ideas just based off those. But that's not what's important. It's important to identify the market structure first and use those guys in conjunction with everything. Now, this is all I had for today. It was a very extensive market structure lesson and candlestick lesson, and I just talk to you guys a lot about the stuff about impulse moves, the breaks, and everything. There's a lot of information in this lesson, so I want you guys to go out, test it out, practice it a lot before applying it, and then let me know in the comment section how that went. But in terms of next lesson, we're going to talk about order flow. I'm going to be introducing order flow. What is order flow? The inventory and the DOM, the footprint and execution. So these are very important tools to actually start solidifying entries and exits and become a more consistent and sniper worthy of a trader. So these really identify those little intricate levels to the tick, to the level of entries and exits. So that's what I'm going to be going for. And if you want to know more about order flow, we've got a link down below in the description if you guys want a free order flow lesson. So if you guys have any questions, I'll open the floor for the next minute or so to let the questions flood in as there is a slight delay here on the live. But I hope you guys really enjoyed this video and let me know what you guys think below, what you guys want to see next as we do continue this series, a planned series. Again, if you guys don't want to miss out on that special offer at the end of this series, there's a link down below. Sign up there and you will receive a invitation to something fun. Now, just waiting here for a few minutes. If anyone has any comments or questions, I'd be glad to answer them. Down below. Sign up there and you will receive a invitation to something fun. Now, just waiting here for a few minutes if anyone has any comments or... All right, guys, so we're going to wrap this up here. I hope everyone had a great time, and remember, next week is lesson 4, so get ready for lesson 4 as we're coming through the halfway point. So we do have one question. When you see several large body continuation candles followed by a singular very large body candle in the opposing direction, what are you looking for to get in for a counter trend? Whoa, that's a heavy-weighted question. It comes down to the market structure at that point. I won't put a lot of weight on a single candle or a cluster of single candles. It really depends on where the market structure starts and how the market structure holds out at that point, Rock Outfitter. So if the market structure identifies that that large candle is actually breaking the current market structure. So if that large candle actually breaks the current market structure, I'm waiting for a consistent break through that area, whether it's at a top or a bottom, and a pullback into that area. It's not identifying just purely on a one candlestick for the counter trend move, if you're looking for that. Identifies that that large candle is actually breaking the current market structure. So if that large candle actually breaks the current market structure, I'm waiting for a consistent break through that area, whether it's at a top or a bottom, and a pullback into that area. It's not identifying just purely on a one candlestick for the counter trend move, if you're looking for that. Anytime, Rock Outfitter. Identifies that that large candle is actually breaking the current market structure. So if that large candle actually breaks the current market structure, I'm waiting for a consistent break through that area, whether it's at a top or bottom, and a pullback into that area. It's not Patrick, if I'm not using the footprint for the entries, either or, honestly, I prefer the four tick because that means it identifies just one point of movement. So I really like the four tick. It just gives you the difference between the four tick and the five tick are just one tick, so it's not too much of a big deal. But I like to see the more intricacy on the four tick, so I'll just base it mainly on the four tick if I'm not using the footprint. Thanks for the question, guys. And yeah, thanks for the question, guys. I hope everyone had a great time here. Thank you so much for joining me, and we'll see you guys next week in the next lesson. So, looking forward to seeing you guys there, and take care, everyone.